to call out, let's call out a 2-minute warning. Hello? Hello? Is that popping? Is that popping at all? No? Hello? You get me? Let's call a 2-minute warning, folks. Hey, how about we get started in about 2 minutes? There we go. Guy at the desk is over here. I had this thing all teed up and tuned up, and this obnoxious guy from out of town. Well, I'll tell you, it's a lot more exciting being a fixed income investor nowadays. 3 years ago, it was tough to get anybody to come to an event like this because there was just no interest. So now that I have your attention, please ask a lot of questions because I got a repertoire of these as long as my arm. So you definitely don't want to let me go off script. But good afternoon, everybody. It's great to be here. My name is Bob Cataldo. I'm the Chief Investment Officer and Chief Strategy Officer at UFG Insurance. And this segment of the program is dedicated to investment considerations on the part of carriers and insurance investors. And I want to thank Kevin Croft and Drake University for affording me the privilege and the opportunity to moderate this panel of experts to my left. And I'll give them a chance to introduce themselves. But we hope that through the conversation today, we can impart some insights and some perspectives and maybe a few best practices on the investment or the asset side of the balance sheet, if you will. We're definitely living in interesting times, and investments is exciting once again, and I'm sure the panelists will share the questions that we now get asked that, like I said, weren't getting asked a few years ago. But without further ado, I'll turn to my left and let Dennis introduce himself.
Hi, my name's Dennis Mentgen. I'm Chief Investment Officer for Principal Life Insurance Company here in Des Moines. I've worked with Principal for 29 years and had the privilege to move through various chairs there in the investment department and landing where I am here now. I started my professional life with Deloitte & Touche, so by training I'm actually a CPA, went to the University of Iowa, and proof that there is, the business background and the education that you can get is very flexible. There's a lot of places that one can land, and I'm happy to say that we're to be here today and to share what we can. Hopefully, Bob won't ask me any hard questions.
Hi, everybody. I'm Brad Fredericks, the Chief Investment Officer for EMC Insurance. We're a property casualty insurer here in Des Moines. I've been there about 13 years, and prior to that, I was actually at Principal. Worked with Dennis for about 12 years before that. So a little bit of life insurance background as well as property casualty. And similar thoughts as with the prior two gentlemen. Like, it's an interesting time to be investing again. There's actually opportunities, but there are still risks. So we'll hopefully dissect some of those this afternoon.
Hi, everybody. Jason Clark. I work at Blackstone in our insurance solutions business. So we manage investment portfolios for insurance companies. We manage about $150 billion of insurance AUM. I started my career at Goldman Sachs in their insurance business, which went on to become Global Atlantic, and spent several years there before joining Blackstone.
Great. Why don't we kick it off at a high level? Maybe each of you talk about how do you approach structuring insurance portfolios? What are some considerations that you take in doing so? Sure, Dennis.
Well, we are a liability-driven investor. Means we start with our products and the needs that they have. We have what we call a segmented general account. So pools of products that have similar characteristics are segmented off, and we design an investment plan that meets the needs of that particular investment. We like to, again, if it's a spread-based product, you set that interest margin in, match up your durations and your key rates, and you sleep well at night. And no, so that, again, that's the way that the first order of business is to be a liability-driven investor. We need to be risk aware. We need to be efficient with our use of capital. We are regulated as an insurance entity, prescribed amount of capital that's required for us to hold, and a target that we have that provides a buffer of capital well beyond that, because our ratings, if you will, are a product attribute as well. So smart use of capital, good returns, good risk-adjusted returns, both to our liabilities, our customers, and to our shareholders too. So that's how it starts.
Thank you. Brad?
Not too different from what Dennis mentioned, but the one thing maybe to differentiate property casualty from life is our liability cash flows are not nearly as well defined. So we've got to have a significantly more liquidity in order to pay for claims when they come up. You could have a storm hit tomorrow, and we've got to have the money to pay for that in, say, 3 to 6 months, whereas life companies, they have a pretty good idea of when those cash flows are going to become due. So we have a similar asset mix, I would guess, but probably a little bit more heavily tilted towards liquid assets and some surplus assets that are geared for more higher return.
Yeah, I think we'll sort of ring the same bell. When we help our clients with their strategic asset allocation and portfolio construction, it really starts with understanding the liabilities. What are the projected cash flows in the base case, and then what's sort of the variability around that, and making sure that in any kind of market scenario or liability scenario, they're there, the cash is there to pay their claims first and foremost, and only from there can we, get into kind of return optimization or capital optimization.
So taking it down maybe a few thousand feet, talk about a day in the life for a CIO or a portfolio constructionist or portfolio manager, and how do you reflect upon a culture of risk management within your organization? What does that mean to you? Jason, do you mind starting this one?
Sure. So for me, it's a little bit different because we're an investment advisor as opposed to sort of a principal investor like the other two. So it's really understanding of the client's risk framework and their risk appetite, and then working within that to help them build portfolios. And once you kind of get past the kind of bigger picture strategic asset allocation, how much do you want to allocate to the kind of broad strokes asset classes, then finding specific deals that are interesting and work for the client and are differentiated and are really, have a lot of credit support, particularly at this kind of point in the cycle where, the macroeconomic environment's a little bit less certain. We want to make sure that we're buying really good assets, really high in the capital structure, to kind of withstand what may come over the next 12 to 18 months.
Brett?
I would say Jason said he doesn't really get that close to it, but that's pretty much exactly how we do it as well. Maybe I would just clarify one thing. We have kind of a strategic asset allocation. That's not really going to change. It might change every 3, 5, 10 years. But on a day-to-day basis, we'll do some tactical changes where we'll take one asset class up a few percent or down a few percent away from that strategic allocation. But other than that, I think it's pretty similar to what Jason mentioned.
Do you have defined tolerances above and below when you say take up or down? Is that part of the strategic asset allocation framework?
Yeah. So we have defined tolerances within our investment policy, which is loosely based on, the investment or the insurance code for the state of Iowa. But we have within that, then that strategic allocation, we have that set, but the tactical, we could really go from there all the way up to the limit or all the way down to zero. There's not like a band around that strategic allocation. In practice, we're not going to go that far, but in theory, we could.
Dennis, day in the life?
Well, risk management is a day in the life. It's a part of everything. Every day when you're turning on the news, you want to make sure you understand what new thing happened, what impact that may have on your portfolio, how that may shift risk and return opportunities for you. And to that extent, again, we follow a strategic asset allocation framework, but then each quarter we will devise what we call a purchase asset allocation plan that fits where the flows are, again, matching up the assets that we purchase for the liability flows that we have, and also repositioning them the balance sheet to the desired mix that we have for that particular point in the economic cycle, again, within the bands of the strategic asset allocation plan. Risk management is a key part of everything that we do. The investment risk team is embedded with my portfolio management team. They sit shoulder to shoulder. If there are new investments that we're coming through, or if we're trying to discuss what sort of concentrations we want to have in the portfolio, you just have to turn around and talk to the guy. So again, it's just a day in the life is risk management.
So let me pull on that a little bit. So if you had a portfolio that was constructed with entirely 100% treasuries, would you call that a risk-free portfolio?
I would call that an extremely risky portfolio and a sure way to go broke. I wouldn't have to hold any capital against it, but I would be losing money because obviously my products are not at a risk-free rate.
So again, you talked about information and the speed of information now and how it becomes embedded and reflected in the market and prices. Brad, Jason, can you talk about how you look at that when you see a tape bomb or some news flash come and you look at your screen and you see the 10-year move or the S&P move or futures move? How do you differentiate the signal among the noise or from the noise?
Yeah, I'm happy to start. So when those sort of big events hit, I think one, being able to kind of harness technology to be able to dig into your portfolio. For example, we saw the wildfires in Maui a couple months ago. To be able to dig into your portfolio and say, here's exactly my exposure in Maui. I have this, CMBS bond that is backed by a hotel in Maui, and how's it, and so you can just identify exactly what the risks are and kind of monitor them and deal with them as appropriate. So that's more from a defensive kind of risk management perspective. From the offensive kind of investing perspective, at least, at Blackstone, our philosophy is less sort of kind of trying to capitalize on day-to-day moves in markets and more thematic, and sort of what are the industries that have real durable long-term tailwinds behind them, and put our money there. So examples that we like right now include kind of the energy transition. We think that's going to be a sustainable theme. Logistics, as more shopping moves online, as supply chains are sort of reconfiguring themselves. I think there's a lot of room for kind of transportation and logistics in the US. And another big one is around AI, which we've seen really this year. And so data centers, cell towers, kind of the infrastructure that supports that.
Brad, how about you? You flip your computer on, you see the same Bloomberg scroll that everybody else in the world sees. How do you hesitate from acting when it seems like you should be doing something?
And I would go back to kind of our strategic allocation and then our tactical allocation. And we have, I wouldn't say it's a quarterly plan, but we meet every week to talk about, we do a market update every week. And we kind of gauge then which sectors we think are looking more attractive today versus yesterday versus last week. And if we get new money that comes in during that week, we'll allocate to those assets. And given how much volatility has increased in, say, the last 12 to 18 months within the fixed income markets, it's making sure you're not buying an asset at the worst time, if it's gotten richer by 10, 15.
We like to say we weren't wrong, we were just early, right?
Yeah, exactly.
So I think it's also important that you try not to prescribe an outcome, but define a range of outcomes, and be, as you said, very transparent with the leadership team, with your board, with your risk management as part of the ERM process with your risk manager, whoever the corporate risk manager is, to make sure that the views that you have from an investment perspective fit into the overall corporate risk appetite, and not be afraid to be challenged. I think the important thing with being a good investor is being willing to take a little constructive feedback and challenging to your thesis, or a challenge to your thesis, because again, it strengthens it. Or it opens up a flaw maybe in your thinking that, again, we all have biases, and we talk a lot about cognitive bias in the world of investing and trying to avoid that. So I think the idea of transparency and not being too prescriptive on this is what I think will happen, but this is what I think the range of outcomes could be, and here's how our portfolio will behave within this range of outcomes. Now, if we go to the tail events, again, all bets are off. You can't manage the portfolio for a nuclear holocaust. So let's kind of talk about, the theme of the conference is risks and opportunities. Let's start with opportunities. Where are you seeing the most attractive opportunities in the market currently? Brad, you kick this one off.
So I would say right now we really like mortgage-backed securities, and actually agency mortgage-backed securities is probably it's been our cheapest sector for
There's a buyer missing in that asset class, isn't there?
There definitely is, but I think it's actually helped us. Like we were talking earlier, from a total return perspective, it's been awful this year because they've really lagged. But it's given us more opportunity to put more and more of our new investment dollars into that asset class, which we think over the long term, given where we're at in the economic cycle, will really outperform.
And I think that's a differentiator between P&C, which United Fire and Casualty, I'm a property and casualty CIO as well, versus a life. A life portfolio is more about asset gathering and really more about the asset side. And with us P&C schleps, we like income. We need to preserve surplus and make sure that we protect policyholder surplus, but it's the opportunity to build investment income to support the operations of the insurance company. That is the primary objectives for us as well. Dennis, opportunities in the market?
I certainly agree with the
We have
the
groupthink.
opportunity that there is in the MBS class, but it doesn't fit our liability-driven investing structure all that well. It is important for us to have it as potential liquidity, but it is because of the convexity and again, trying to lock in that NIM as well as you can. There are better alternatives out there for us. We had a reinsurance transaction that took place a couple of years ago, which actually took a lot of our liquidity risk off of our balance sheet and made our remaining liabilities much less liquid, more of an opportunity to have good modeling of when to expect that those cash flows would be needed. And that has opened up for us a greater emphasis in private assets, both private credit, high yield private credit, and increasingly private ABS as well. Again, great opportunities there to pick up the illiquidity premium and frequently some additional spread available for complexity in the securitization process and other things. But as it plays against our liabilities, again, fits very well. We can fit it into the duration buckets that we need it to. And because of that additional premium, it's easy on capital and provides a good ROC then for our shareholders as well.
Jason?
Yeah, so a couple areas I think are kind of good opportunities right now. One is just where rates are. The 10-year hit 5% earlier this week. It's a good opportunity to put on duration, especially for life companies with really long liabilities. Now is a good time to lock in those rates. I think if anyone on this panel, if you were offered an investment grade corporate bond yielding 6 or 6.5%, 2 years ago, you would have jumped at it. And so now we have the opportunity. So we're doing some of that, which is not the most exciting, but it's important and it's part of the bigger portfolio construction. And then another big area that we're seeing a lot of opportunities, we're seeing banks pull back from lending. After the kind of turmoil that hit the regional banking sector earlier in the year, bank regulators are kind of cracking down. Bank regulatory capital requirements are increasing, and so they're pulling back from lending. And that sort of opens up an opportunity for other pockets of capital like insurance that have more kind of stable funding sources. Our policyholders aren't depositors. They're here for a long period of time. And so private credit is actually a great fit for insurance. And there's a big opportunity now to kind of pick really strong credits because there's just a lack of capital.
So maybe if we transition to risks that we're seeing, would you identify a risk in the private credit asset class as one being we really haven't seen that asset class go through a cycle, a default cycle? And how do we know, how has that asset class been tested in what I'll call more restrictive? And you could argue that financial conditions are very restrictive now. In more restrictive, from a default cycle perspective environment, how do you feel private credit is set up to perform?
Yeah, so I mean, we have, at Blackstone, we've been doing private credit direct lending since I think 2006 or 2007. So we very early on kind of went through a cycle, and then we went through kind of COVID and some, kind of smaller cycles, I guess, in the intervening years. But beyond sort of like purely private credit, we have a lot. We have the leveraged loan market. We have sort of the broader kind of high yield corporate market to look at.
Direct lending is only one aspect of private credit.
Right, and so other aspects of private credit, like private asset-backed credit, while in its private form hasn't existed that long, it's existed in the public markets, and the underlying collateral has existed for a very long time. And so we can look to the experience of what happened with consumer debt or credit card debt or whatever those underlying collateral really is over the long term, and then see how that would fare kind of based on the kind of current structure that those investments sit in.
Thank you. Brad, what are the key risks that you're seeing now that keep you up most at night?
For me, it's really the economy and when are we going to get to that tipping point? Is the Fed going to push us over? Are they going to engineer the soft landing? Or
Talk a little bit about what the Fed's been doing and what they're up to now. I don't know how many in the audience are every day at the dinner table talking about the Federal Reserve and monetary policy, but for us investment wonks, we do, unfortunately have to. But maybe you can just paraphrase, or, kind of cuff the audience. What's been going on?
2 years ago, the Fed funds rate, which is the rate that banks can borrow at, was between 0 and 0.25%. Now it's 5.25% to 5.5%. So that's 5 percentage points in 2 years, or a little bit less than 2 years.
Fastest ever, right?
Fastest ever. So it's increased the cost of doing business for the banks, but also for all of their customers who they're lending to. So they had to cut back on lending because they don't want to take on that increased risk, which has given opportunities to the private credit market. But it's also then caused some of those entities who they're lending to look other places to get that capital that they need.
And in addition to the rate policy, there's this thing called quantitative tightening. Dennis, can you talk a little bit about quantitative tightening and what implications that has for the market?
Well, again, with the pandemic, there was.
Actually, going back to the great financial crisis.
Well, it does go way back to that. In fact, I'm old enough to remember the first time my mortgage rate went below 10%, and I was like, wow, I am rich. And so now when they're, 30-year rates.
There's a pool outside to see how old Dennis is. Drop a card at the hat.
That's why I got gray
Sorry.
up here. But now that that the 30-year mortgage rate is up around 7-8%, I'm like, come on, we should probably get used to this because I think that's where we're at. But there was a lot of quantitative easing that went along with all the federal programs to flood aid out into the.
And that was
economy.
basically the Fed buying bonds, buying mortgage, buying
Yep.
securities out of the market, out of the open market, and taking their balance sheet from basically 0 to 8-9 trillion in the span of
Right.
10 years.
And now it's the opposite. Now they're selling. That's why your reference earlier to there's a buyer missing in the MBS market, because the Fed is a seller, net seller now, and not a net buyer. And obviously that creates opportunities for folks that have some liquidity and the availability to provide that liquidity to the marketplaces. All the changes that we've seen, a lot of them spurred from the great financial crisis and banking regulations, have opened up opportunities for insurance companies, other providers of capital, funds. A lot of funds have been started. I'm sure you have a lot of them. But it makes the Fed policy transmission mechanism maybe a little bit stickier than what it used to be when it was directly more of a pass-through through the banking, because now you have these other pots of liquidity out there that they have to try to figure out how to weave their policy through these other sources of capital that can be provided. I think those other sources of capital can be a dampener to cycles. But if there is a hard stop in liquidity, again, the old phrase, when the tide goes out, we see who's swimming naked.
Jason, any follow-on to key risks that you're seeing in the market above and beyond what we've talked about here?
I sort of segmented into the kind of broad categories of like corporate, consumer, and maybe real estate, kind of three of the big categories we think about. In the corporates, and I think a lot of the risk really stems from higher rates, which I also cited as the key opportunity. It's also probably the driver of a lot of the key risk, because every sort of borrower is just facing higher funding costs now. I think in the corporate credit space, we're seeing it kind of emerge first in leveraged loans because those are floating rate, and so the impact of higher rates hits immediately. Whereas in investment grade and high yield credit, a lot of companies kind of refinanced or termed out their debt in 2020 or 2021, and so they still have locked in some of those low rates. So I think we'll see that start to crack a little bit later on. In the consumer space, we really see sort of a tale of two consumers. One, and to us, like where we see a clear dividing line is between homeowners and renters. Renters, over the last couple of years have seen their biggest expense, which is the cost of their home, increase a lot. Whereas homeowners who have, for the most part, locked in 30-year mortgages, but pre-COVID at 2-3%, have not seen their expenses increase, but they have seen their wages increase. So they're actually in really good shape, the kind of higher FICO homeowners. And so when we lend in the consumer space, we're really focused on that segment. And then in real estate, again, it really depends on the property type. Office is obviously really struggling, whereas we're still seeing really strong cash flow growth in things like multifamily or logistics or data centers.
I'd like to come back to real estate if we have time, but next question would be around mark-to-market losses. And we've talked about the increase in interest rates. And among the panelists here, I'd imagine the majority of our assets are held in fixed income, or at least a large part of them in fixed income. How have the mark-to-market losses impacted you, and then how has it influenced or impacted your decision-making as you look forward?
Because they're rate related, I'm less fussed about the $6 billion negative AOCI I have in my securities portfolio right now. Now, in the great financial crisis, I had a $7 billion negative AOCI in my securities portfolio, and I was a little bit more anxious about that one because a lot of that was spread related and rates were low.
Credit driven.
Yeah, that was more of a credit driven AOCI. So where they're at right now, I don't care so much because, again, we sold a liability that had a certain rate. So it doesn't get marked on our balance sheet, but you've got an unrealized gain on that liability, and it offsets. It's a natural offset then to what does get marked on the asset side. So we're okay with that. It does provide opportunities. You do want to be able to step up your net investment income that's above the line. And as a taxpayer, we have to manage, you can only deduct losses to the extent you have gains, and so you have to find other things in your portfolio that you can harvest gains on and meter things out. But I'm okay with where we're at right now, again, because it's rate driven and not spread driven.
Brett?
I would totally agree with Dennis there. As a property casualty insurer with a rather large public equity portfolio, it's allowed us to move up our investment income because we can sell bonds at a loss and offset prior taxes. We paid a lot of taxes in the last 5 years on gains in our equity portfolio. So now we can take these losses on our bonds and offset those prior taxes and move up our investment income or our book yield of the fixed income portfolio. I think last year it went up 75 basis points. This year it's up about another 50 basis points for the fixed income portfolio.
Jason?
Yeah, so a lot of times when insurance companies partner with us, it's because they want to rotate a portion of their portfolio from kind of traditional fixed income into structured credit or private credit, which is what we sort of specialize in. And that rotation becomes a lot harder when you have big unrealized losses because it has impacts to your statutory capital, your solvency ratios. And so it's been a challenge that we've had to work through. People have sort of an IMR budget to absorb some of that, but it's certainly kind of front and center, particularly if you're kind of undergoing a change in your portfolio strategy.
Yeah, I think the impact of book value is certainly not favorable, but the opportunity to improve investment yield and investment income more than offsets the pain you take to the book value decline from these types of haircuts. Regulatory rating agency environment, maybe from each of your perspectives, what's new on the rating agency or regulatory environment that you're paying attention to or dealing with, and maybe what's coming down the road that is on your radar?
Happy to start.
Thanks.
I think, as a lot of insurance companies are investing more in structured credit and private credit, we're seeing regulators spend more of their focus there. And so there's been a host of kind of new rules that have been proposed through the NAIC and are working their way through now. And so I think what we can do is just help our clients stay really close to it and, make sure their portfolios are sort of positioned well, kind of no matter what the regulatory outcome is.
Yeah, for us, again, the rating is a product attribute for us, so we have to pay attention to rating agency models. We have to pay attention to the RBC model, risk-based capital model from our regulators, and we have to pay attention to our own internal economic capital models. So there are a lot of different ways that we have to try to optimize and balance our portfolio, strike the right balance. Standard & Poor's kind of stepped in it a couple of years ago when they wanted to bring out a new capital model, and they said, hey, if it's not rated by us, we're going to notch it down a couple and apply that capital weight to it. That got a lot of people excited, including the federal government, and said, that may not be the best move. Doesn't sound sounds anti-competitive, if you will. So maybe you ought to rethink that. And they have floated out another capital model. Of course, the RBC model, S&P capital model, they're all trying to be able to address the whole industry and try to differentiate, amongst different accounting models, different, regulatory regimes, trying to hit it down the middle. And you're always going to find things as an individual company that you can nitpick around on those things. But managing those relationships with the rating agencies and with the regulators is important. I think there are for a life insurance company, there's a lot of potentially substantial developments going on right now with the NEIC and the SVO, including a complete rethink of exactly what it is they're trying to accomplish with ratings and how much they can rely on NRSRO's nationally rated statistical
Nationally recognized
rating, or I don't know what it is, alphabet soup. And I think it's great. I think it's a great initiative. I think a lot of our leadership here in the insurance industry in Iowa have helped, with a lot of thought capital there. But there was a recent change a couple of years ago, and all of the capital factors that they went from 6 factors on ratings within year to 20. That changed things up a bit. They've revised, try to get smarter every year, but it's time consuming. There's a lot of advocacy that goes on around that, and they're even, what is a bond? I mean, that's a project that there's ongoing.
Scary when regulators or rating agencies get philosophical.
What exactly is a bond? So it fits within their capital regimes and things. So we have to keep close tabs with that. We have to maintain good relationships with our regulators and rating agencies. It's just a part of doing business.
Brad?
Well, as a mutual insurance company with really very little debt outstanding, our primary rating agency is AM Best, and obviously we deal with the state of Iowa as the regulator, but we don't have probably as many concerns just given the lack of tradable debt outstanding. But we still do deal with them. I mean, we meet with them annually. We have to give them quarterly updates on how the portfolio is doing, how the business is doing. As a property casualty insurer, fortunately, I should knock on wood, right now it's really more about the business versus the investment portfolio that they're worried about.
Let's talk a little bit about geopolitical risks, and it seems to be a new flashpoint almost daily. How are you considering geopolitics and what's happening in the world today, and how is it impacting your portfolio? Brad, you want to pop that one first?
Sure. So I would say, given I mentioned earlier that there's increased volatility within the fixed income markets really the last 12 to 18 months. And what has that really caused us to do is keep the portfolio much closer to our strategic allocation. We haven't been making as large of tactical bets given that volatility. And I would say the increased geopolitical risk that's heightened right now is just making it even more so, where we stay closer to home with the portfolio.
Is it the uncertainty or the volatility? And I know they kind of sound the same, but they're not.
Yeah.
Uncertainty is the unknown, but volatility can be a very healthy thing that loosens things up and presents opportunities.
Certainly. And if we got to a point where we were comfortable as a company and as a team with knowing or having a fairly high confidence level of what the outcomes were going to be, then we would take advantage of that volatility. But right now, given the uncertainty about what that outcome is going to be, we're staying much closer to home.
And that's a subtle nuance between risk and uncertainty. Risk you can quantify, right? You can put a number to it or a range of numbers to it. Uncertainty is unquantifiable.
Yep.
And I think we try to avoid scenarios where there's uncertainty that you have to invest into, but we like scenarios where there's volatility, but there's risk, obviously, but it's quantifiable to a certain degree.
Yep, I would agree.
Jason?
Yeah, I mean, I would sort of echo that. I think geopolitics is unpredictable. And so, I think as insurance investors, we're best served by sticking to developed markets, stable regions, and in the companies and the credits that we invest in, ones that we have high conviction in for the long term and are able to withstand kind of the second order effects of these geopolitical events like volatility in energy prices or commodities.
Dennis.
Oh, I think that's exactly right. You need to be aware of the risks that are out there. Try to build an all-weather portfolio because these flare-ups will occur. And again, your risk appetite for how much do you want to have in developing markets, or, again, you make an assessment. We have, again, a lot of folks in government relations and on our risk teams that are thinking about these things. They're frequently at our investment committee meetings to talk about, what's going on, what are the ramifications and implications that might have to, not only our operations and the safety of the people that we have around the globe, but, the longer term sort of secular trends that implies for where you want to put your money, because we are investing for literally people's lifetimes. And again, we'd like to be able to, as much as possible, set it and forget it. And so you have to take these things into consideration, but you have to also recognize that is the course of human history. This stuff happens, this dysfunction, whether it's across borders or if it's within a particular building in Washington, D.C. I mean, it all matters, and you have to be tuned into it, and you have to be able to adapt quickly sometimes to those changing environments.
So this might be a bit philosophical, but I'm interested in your perspective. Are there bad risks or bad prices? Jason?
I think I'm in the bad prices camp, but I also am in the camp that we are investing insurance money. And so, like Dennis said, this needs to be here in 50 years when people, need it or their families need it. And so I think for insurance, where you want to be at the top of the capital stack and you want to be in a more risk sort of defensive position, there are bad risks.
I would totally agree. Any risk that you invest at the wrong price is a bad risk.
But if you got the right price, would it be a bad risk?
It still could be. You'd really have to understand, make sure you totally knew each potential outcome of that risk, weighted them appropriately, and then made sure that your assessment of the price was the right one.
But we're always dealing with imperfect information, right? Knowing that. Dennis?
No, there's more risks to your business model than just the risks that can come from a capital loss or something like that. There's reputational risks. So yes, there are things that you can get yourself into that won't play well in the Wall Street Journal or in the Des Moines Register. And so yeah, there are risks you don't want to touch with a 10-foot pole.
Let's do some quick fire topics and just get first thought in your head as we think about commercial real estate. Headwinds, tailwinds. Where are we at with that? That's not as quick as I'd hoped, but this could take us to the end.
I could tell I was in the spotlight on that one. If you don't know, Principal Life Insurance Company and Principal Asset Management, Principal Financial Group has a substantial real estate operation. We have been a long-time provider of capital, both at the equity side and on the debt side, public debt, public equity. We've got all four quadrants covered with our operations, and we think we're pretty darn good at it and have a track record to prove it. Office is weak, but it will recover. We will find a new equilibrium there at some point. There are sectors that have already been highlighted. The logistics, industrial spaces, data centers, multifamily. Just housing affordability is at a 50-year low right now for a variety of reasons. People that have these 2.5% mortgages don't want to move, and homeowners look at the cost of, or home builders look at the cost of capital and say, I can't afford to build anything new either. So we're underhoused, which is a great fundamental, But that also serves then as a level that, a floor to how bad things can get, at least in our opinion, in the multifamily space for some period of time here now. So multifamily is a good space to be in. Single family residential is a good space to be in. Industrial, data centers, those logistical angles, the last mile, great places to add. Office, you need to be extremely careful. It is all about location, 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 the quality and diversity of the tenant roles that are going to support that. Retail, again,
Very selective.
it's very, very selective. You hear a lot of headlines of stores closing, the retail shrinkage issue of shoplifting and organized crime and shoplifting. Yes, certain stores will close, but for the third year in a row, there's actually been net store openings, and that's the part that you hear, that you see the clickbait headline that things are bad, stores are closing, but we've had net store openings for the last 3 years running compared to net closings during the pandemic times when nobody went out and nobody bought anything. So again, you have to know where you're going. You have to be selective. Office is going to be soft for a while. I think a lot of the public real estate funds, we probably still haven't found the floors and valuations that need to be there. I think there's still maybe a bit aggressive, sub 5% sort of average cap rates when you can go buy a treasury at 5%. And so you're like, my real estate stream is valued at 5, and I can buy a treasury at 5. Something's not quite right here. Now, there are dislocations over the history of time where that's true, that the real estate markets kind of look through the cycle of how high rates are and how long they might be there. But the more persistent we are at these 5% levels, the more difficult it is for those valuations to stick.
Brett, talk about the banking sector. Let's pivot to that. Regional banks, not the significant, the Goldmans, the JP Morgans, but what's happening in the regional bank sector in your portfolio without specific, line items, but what are you seeing and what sort of dynamics are happening there?
So we have historically avoided the regional banking sector, not for the reasons that came to highlight in March, but just because we weren't sure that the appropriate risk mitigation measures were in place there. And as it turns out, maybe they weren't in place. But I think part of that regional banking sector is going to help out in what Dennis was just talking about here, that price discovery in the commercial real estate market, especially in the office sector. There are some commercial or regional banks that have a fairly high exposure to that particular asset class, and likely there's going to be some price discovery that has to happen that may provide opportunities for some of the rest of us that don't have that exposure currently.
Jason, Bitcoin is an asset class.
Again, not for insurance, not one that we would touch.
I agree. All right, with that, I'd love to open it up to the audience. If you have any questions for the panelists, hopefully, please feel free to raise your hand and we'll get a microphone to you. We've stunned them all into silence. I feel a joke coming. Oh, thank you. The audience thanks you.
Hi. Thanks for the insights. Can you guys share a little bit on how you look at liquidity, what kind of metrics you do, or how you plan for liquidity needs through this kind of cycle?
Sure. As I articulated earlier, our liability profile doesn't demand a lot of liquidity, but obviously we do have scheduled maturities of things, and because of the businesses that we're in, some of them can be lumpy. So we do have to plan for that liquidity. We do a fair amount when you start getting inside of, it's not just duration matching when you get into those shorter buckets, but it's kind of cash flow matching as well. And we track very closely with our treasury team just exactly what our net position is. And then there are a number of scenarios and stress tests that we go through to stating the obvious, stress of what those liquidity requirements are, and then we make sure we're staying within bounds with cash and short-term liquidity, and also then highly liquid assets that we could move at a reasonable cost to our capital position if need be. So it's something we monitor very closely with our business units and with our treasury friends.
And maybe just a property casualty take on that. We have our economic capital modeling team does some scenario modeling for us, and they put together like a 1 in 500 year underwriting event or a 1 in 1,000 year underwriting event. And we just make sure that we have liquid assets to cover the liability needs in those outcomes or those events.
Yeah, I would agree with that. I think a big part of it comes down to scenario testing, and in a given rate environment, what at least in the life or sort of the annuity sector, which is a lot of what we focus on, how protected are you by surrender charges? For how many of your policyholders is it economic for them to surrender their policies in a given rate environment, and what are your assets worth in that rate environment? And what other liquidity tools do you have at your disposal between repo facilities or FHLB, other sources of outside liquidity that you can access in a crunch, and making sure that even in a pretty extreme scenario, you can pay your policyholders.
Other questions?
Excellent, thank you. This is more of a PNC question, but how sensitive are you to changes in underwriting appetite? Hypothetical, maybe company goes largely from personal lines to commercial lines, or restaurants to offshore oil rigs. Extreme examples, but could you highlight, a little bit of the sensitivity to investment allocation decisions based on the business decisions in your organization?
Sure. From my perspective, and Bob, feel free to jump in here too, it would really depend on the duration of the liabilities. So if you're a property casualty insurer and you've got property exposure, or if you've got workers' comp, those are very different durations on those two lines of business. So you'd want to make sure you're investing for the durations of those liabilities.
And we do get actuarial analysis on the duration of each segment or line of business to know which are our long tail liabilities, which are our short tail liabilities, and what dollar amount are they. And as Brad said, we try to match it closely. It's not as rigorous of an ALM process as you might have in life, but there is some ALM matching just to make sure that we're not out of bounds from a duration standpoint based on the type of business we're writing. So there is a constant interaction to know what we're writing, if that's what you're looking for too, is that transparency on both sides of the balance sheet.
I think there's one in the back.
Jason.
Well, thank you all for sharing your insights. Bob, you knew this question was going to come. United Fire Group, Principal, EMC, all of you have done some early stage venture investing, either through funds or directly into, say, insurtech companies. What's your current view on that alternative asset class and on venture investing?
Well, I'll take that. I love it. I get to wear both hats, the investment hat and the strategist hat. On the investment side, we look to partner with companies or with funds that have a track record, a process, a pedigree, because we're looking for returns. But on the flip side, those partnerships bring strategic value in the sense that we get to look through to the portfolio companies and the screening process of those GPs to see what sorts of what sorts of entrepreneurs are emerging and what sorts of technologies are emerging that might become solutions for us. And in fact, we invite our business leaders to converse with those partners or with those funds to dialogue around issues that we may be having in our business that could be technology solved. So I'm all for it, and as Jason said, we've taken a very strategic view towards investing in the insurtech community and environment, and we'll continue to do so.
I would say ours is pretty similar. We have done less on
more direct.
less on the fund side, but much more on the direct side, and it's really driven by our operational business units. If they have a problem, they're looking for a solution, they've found one. If that solution provider is looking for new capital or more capital, we've been a provider for that for them. And what it's allowed us to do is get a little bit better terms on the commercial side or better terms on the investment side, making sure we're getting something in exchange for it, but also, like Bob said, really helping us formulate that long-term business strategy of growing that business. And I would say in the last 12 to 18 months, it's gotten considerably cheaper. So that's a benefit for us.
From the principal's standpoint, I know the guy that used to run a lot of the venture stuff here, particularly the Iowa-based investments, and his hit rate wasn't very good. It might have been me, but I'm not sure. But that is the thing with venture investing. It's kind of like being even just a bad major league batter. You can hit, bat 200, and that still might be okay if your winners really play out. Now, that sort of volatility of outcomes doesn't necessarily play well on the income statement as an investment for a publicly traded insurance company that likes to see consistent, steady earnings above the line. And because of the funds would have to be marked to market through investment income above the line, we have reduced the amount of venture investing we've done for the investment portfolio and pivoted our venture dollars into the InsurTech, the incubator funds, those places where our businesses align and can find some ways, some strategic advantages, some new places to go where the return to the enterprise may not be obvious. It may be expense savings rather than net investment income. It may be product design or product offering for a longer term than it looks like the immediate pop if you were just a venture capitalist and, trying to make your money just from that side of the return. So it's a different attitude. We've got it more embedded with the business units. They're much more involved with these incubators and the InsurTech funds. And it's more of a strategic investment than an investment.
I think we are at time. I want to thank Dennis, Brad, and Jason for joining me here. Thank you in the audience and those online for your time and attention. And please join me in giving a round of applause to our panelists.